The other day, I sat down with a branch manager for a local mortgage company and we chatted for about an hour and a half. I asked him a bunch of different questions for you guys. We got it all on video and we talked about everything from starting the process, the documents that you will need to get pre-approved. We talk about pulling your credit and how it affects your credit score. We talked about the biggest factors that determine your interest rate and what your monthly payment will look like for different interest rates. We talk about what you need for a down payment. So be sure to stick around for the entire video because there's tons of good information all the way throughout, and we're gonna hop into that right now. Hey, welcome back to another video. Thanks for stopping by. Nick Paolozzi with RE/MAX Southern Shores. Today I'm with Benji Spivey with RealFi. Why don't you go ahead and tell everybody a little bit about yourself?
Yeah, hey guys, my name's Benji Spivey. I am a branch manager with RealFi here in the Myrtle Beach area. We are actively expanding into the Carolinas, Georgia, and northern Florida. So do lots of business with Nick. He's one of my favorite realtors, so I was super excited when he reached out to me and wanted to do this.
Awesome. So somebody calls you up to get pre-approved, and what does that process look like? What are some of the documents you're going to be requesting? What do they need to do on their end?
Gotcha. So the initial phone conversation will be with myself typically.
Okay.
And then almost immediately, just after a preliminary conversation, I'll get my team involved. And then some of the documents that are definitely going to need to be readily available because we have to request them.
Right.
In order to give you the thumbs up to continue to shop so that we know we can get them done.
Okay.
So just right out of the gate, we're going to have to look at credit. Credit score is the number one thing that we have to know up front.
Okay.
But a close second is income documentation. We're going to want at least 1 year of W-2. Most of the time we ask for 2. And we're going to need the most recent 30 days worth of pay stubs. If you get paid every week, that's 4 paychecks. If you get paid every 2, then we would want 2 paychecks. But typically credit and income documentation. And if we're looking at down payment, we're going to want to see some sort of bank statement, some sort of proof of funds. Okay. Or if it's going to be, if we're getting a gift from a family member, which is maybe something else we could go over.
Right.
If we're going to get a gift funds from somebody, we're going to want to at least document that the funds are available.
Okay. Awesome. So you mentioned like one of the first things that you're going to do is pull credit. A lot of clients, when I'm talking to them and letting them know the process of getting pre-approved, before they even really know that they're going to go out and buy something tomorrow, they get all worried that once their credit pulled, they're going to take a hit on their credit score. Right. Is that necessarily the case, or how does that work?
It is. So one term that's thrown around very loosely, especially in our industry, is the term soft pull. Okay. There is such thing as a soft pull, but 99% of lenders do not do a soft pull. Most of the time it is an absolute hard inquiry. Okay. The good thing about shopping for a mortgage or even a car for that matter is, I can't remember the year, I want to say it was like 2014 or 2015. And you can go to CFPB.org, it's the Consumer Finance Protection Bureau. You can go to the government website and get all this information on your own. You don't have to take my word for it. But back when, in whatever year it was, the CFPB said, listen, we can't penalize these people for shopping, trying to get the best deal or the best rate. So you have a 45-day shopping window that whether one lender or 10 lenders pulls your credit, it's only going to ding you for the one time. Okay. Now the inquiries will if you have 4 different lenders pull your credit, there's going to be 4 different inquiries on your bureau. Right. But the bureau itself recognizes, okay, all these are mortgage companies. This person is shopping to make sure they can get the best deal. We're only gonna knock them for the one. Right. That makes sense. So now, depending on the rest of your profile, the effect that's going to have on your score is always going to be different. A lot of people ask me, hey, how many points is this going to knock my credit score down? Well, sometimes it's 3, sometimes it's 23. There's just, depending on the history of your personal report is what's going to dictate how the algorithm dings you for that inquiry.
That makes sense. I think probably the biggest takeaway from that is, if you've already talked to a lender and you weren't really happy with that conversation and how things went, and you're worried about getting another big hit on your credit like a week or two later, that's probably not going to be the case. Once you talk to one, you have a little bit of time to talk to another, and you're not really going to see another effect on your credit, right?
Correct. Well, and you know that you're working it with an honest lender, and I'm not going to use, they may not be the most inexpensive, they may not be the best rate, but you know you're working with an honest lender when, like I tell my clients, hey, here's the shopping window, check it out. I'm not saying I'm going to be the best rate. I'm probably going to be the best process, and there's a premium that you pay for that.
Yep.
But I let them know they have time to shop, and that they have a shopping window, because I don't want them. I'm looking after the client first and foremost. But if there is a better deal out there, maybe I'm not the best deal, or maybe I can match it. There's a lot of conversation to have, but you absolutely, no matter what your lender tells you, you have a shopping window that you're not going to get penalized.
Cool. One of the main questions people ask me when I'm talking to them and they're starting their home search is, they want to know how much home they can purchase, what they can qualify for. They shoot out an income. They say, I make X amount of money a year. Like, how big of a house can I look at?
Sure. So that's one reason we tell everybody that it's super important. Whether you engage with a realtor or a loan officer first, it's kind of irrelevant. But even if you engage with a real estate agent first, this is why the pre-approval process is so important, just so they can understand. So it's kind of a loaded question, but for example, the best way to put it is there's a debt to income ratio, which is literally your debt versus your income. So what is that percentage of outgoing versus incoming? So when we're looking at debt to income, depending on the product, and I won't get too in the weeds with it, but depending on the product, it may have to be at 43%, 45%, maybe even 50%.
Right.
But within that conversation, what I have to have the conversation with the borrower of, I'm qualifying you on your gross income. So this is before Uncle Sam takes his cut, and this is before your food and your gas, and you've got to live. So a lot of times it's a healthy conversation because I can qualify you for more than may truly be comfortable.
Right. Okay.
But so the short version is there is a calculation to that, and we typically back our way into it. We will get an income and kind of figure out where their pain threshold is for a payment. Okay. And then from there, we'll kind of gauge what they can afford.
Awesome. And you mentioned the debt to income ratio and the percentage there. And that's something that I mentioned to my clients as well, that's one of the most important things in determining how much they can qualify for. How's that calculated? That's on a monthly basis or a yearly basis?
Yeah, on a monthly basis. Okay. And so we're only looking at what is reported on their credit bureau. So a lot of people say, oh, I've got $10,000 in credit card debt. Okay, well, if that minimum payment's only $150, that $150 a month is all that we're concerned with when it comes to the debt to income calculation. But the way we calculate it is after we pull credit and we look at the full picture, we calculate all the minimum payments, vehicle payments, installment loans, whatever it may be.
Okay.
And then we add all those up and we divide it by your monthly gross before tax income. And that's how we come up with that percentage.
Awesome. Okay, cool. So along those similar sort of lines, when I start telling people, it really depends how much they can qualify for. And the biggest thing, again, is that debt to income ratio. People always want to know, okay, if I could qualify for, let's say, $300,000, what is my monthly payment going to look like if I put, let's say, 10% down?
Right. I mean, that's a loaded question, like most things in mortgage. But let me do this. I can actually, if we can be candid for a second. Go to a mortgage calculator here, and we'll just use 300.
Okay. 300,000. That's kind of like the average right now. So
as a property value, or a purchase price, and then let's say you said 10% down.
Yes.
Just random. So $300,000, 10% down. So principal amount you'd be borrowing would be $270. Now this is we're talking what we call a PITI payment. So that's principal, interest, taxes, and insurance.
Okay.
Now, in this case, I'm only talking about principal and interest because this mortgage calculator, depending on where the property is, taxes are going to change, insurance is going to change.
Right.
At only 10% down, you are going to have mortgage insurance.
Okay.
Your credit affects what's that going to, so it's a loaded question, but just for an example, $300,000, 10% down, which is $30,000, at 3% interest on a 30-year mortgage, your principal and interest payment is $1,138. So then if the borrower or the buyer knows, hey, my payment's going to be $1,138, and through shopping you can say, okay, the tax rate in this area is X.
Right.
Then from there, you at least have a gauge to kind of back into adding it together and knowing what the payment's going to be. But again, big reason to get pre-qualified so that you know, hey, a lot of people, they'll say, hey, I want to spend $450,000. Well, when they see what the taxes on a $450,000 house are plus everything else, they quickly decide that maybe they want to buy a $300,000 house.
Yeah, it changes things a little bit.
Correct.
Okay.
And just with since we're on the topic, so from 3% to 4%, just as an example on the same scenario, now at 4% versus 3%, so at 3% we're $1,138, at 4% we're $1,289.
Okay.
So just call it $150 difference, and the higher the loan amount goes, the bigger the difference it makes because you're borrowing more, you're paying interest on a higher dollar amount.
Okay, awesome. So you mentioned two different interest rates, 3%, 4%. What is the biggest factor that determines what somebody's interest rate is going to be?
So, another loaded question. The biggest factor that determines the rate is going to be two things. It's going to be their credit and the loan to value. Those are going to kind of be the two highlights that are going to dictate it. But what I enjoy going into with borrowers a lot, whether you're a 580 or a 780, I can get you whatever rate you want. What changes is the cost of that rate, which is referred to as points. So if your buyer's in the process and they say, oh, my lender told me I'm at 3%, but I got to pay 1 point. A lot of times they don't know what that point is, and it is literally 1 percentage point of the loan amount.
Correct. Paid up front. Okay.
You can look at it, I don't like to sell it this way, but you can look at it as prepaid interest. You're buying the rate down.
That makes sense.
So credit score, depending on where you're at credit score wise, it changes that dollar amount. Now, I say whether you're a 580 or 780, I can get you whatever rate you want. If you're a 780 and you qualify for 3%, it may be no cost. If you're a 580 and you qualify for 3%, you may have to pay 4 or 5 points, and the government won't allow me to charge you that much.
Okay.
So there's a threshold of fees that we can charge.
Okay.
So I shouldn't say I can get anybody any rate, but that's your credit score dictates that cost of that rate.
Awesome. I think probably the biggest takeaway for those watching is those mortgage calculators online can probably get you in the ballpark of what you can expect monthly, but really if you want to get down into like the nitty gritty and get exact numbers, you want to call a loan officer like yourself and just have that conversation. This way you can get a little bit more accurate information. All right, let's talk about down payments really quick. A lot of people think they need to put 20% down. What's the deal with that?
So it depends on the product, but yes, the idea of, or maybe even what your grandparents have told you, that you've got to put 20% down is not the case. And in a lot of situations, putting 20% down isn't even the smartest thing to do. Okay. So depending on the product, you can get away with 3, 3.5, 5, 10%, 20% clearly, but you can definitely get away with putting a lower down payment. Now, there's some costs associated as far as mortgage insurance, but again, a lot of times when we sit down and look at the specific situation and do the math, even if they have 20% down, upon doing the math and really having a conversation with them, most of the time it makes sense to put less money down regardless. So no, you do not have to have 20% to put down.
Yep, and that makes a huge difference for people who are starting out, maybe just starting to save some money and looking to buy a home. You're talking about a $300,000 house, the difference between $60,000 versus $10,000 to $15,000.
Correct.
So that number is a little bit more doable for a lot of people.
That's exactly well, and a lot of people, if they do have 20%, they say, okay, and I'll just use easy numbers here. They say, okay, I've got $50,000 that I want to put down. Okay, well that's great. Now we have closing cost. So all of that 50 can't be applied to the down payment because that is every dollar that they have.
For sure.
And like my business partner says, you don't want to end up with not having any lunch money after you buy a house.
Right, that makes sense.
Okay, so like I said, tons of good information in that video. If you still have questions about the mortgage process, go ahead and check out the first link in the description.
I've included a completely free to you mortgage checklist that walks you through the process A to Z, everything that you can expect to happen from start to finish. Again, that's the first link in the description, mortgage checklist download. And be sure to check into future videos because this was only about half the conversation that I had with Benji. Obviously, we condensed things down a little bit for the video, but in the next one, we are going to be talking about a bunch of other good topics, including what you can do to increase your credit score. We talk about mortgage insurance, otherwise known as PMI. We talk about using gift funds to go towards your down payment or closing costs. And a really big one, we talk about what you can do to get a leg up on your competition in multiple offer situations, even when you're getting financing. So again, tons of good information coming in that next video. If any of that sounds interesting to you, go ahead and hit the subscribe button and the notification bell. This way, when it posts, you'll be notified. And as always, thank you for watching. I really appreciate it. If you enjoyed the video, go ahead and leave a thumbs up, and I will see you in the next one. Peace.